Enjoying their Tuesday. Thank you guys for being here. Here for another awesome Tuesday night with Napkin Underwriting. We got some cool things planned today. Obviously, if at any moment you guys have questions, we have our eye on the chat. If you have any deals you want us to look at as well, please let us know. The sooner you let us know, the more likely we can help you out. We do have a hard stop at the end of the hour, so please keep that in mind. For some of the East Coast people, it is late, so we want to make sure we are respectful for everyone and make sure we can get everyone's participation here. It is always awesome being here with you guys. Aldo, we'll all introduce ourselves in a little bit, but my name's Edward again. As you guys may know, for those of you that don't know me, very nice to meet you. And yeah, let's get the show on the road.
Thanks, Ed. Thanks for getting us kicked off. Hey guys, my name is Will. Super excited to have you guys all here this evening, and just going to kind of quickly cover what we're going to be talking about tonight. So, of course, we're starting out with our little introduction here, who we are, and then we're going to talk about our ecosystem and the different Zooms that you can join. And before we get started, I know Travis Pryor, you're new here tonight, but if you're new here tonight, go ahead and throw a 1 in the chat. We'd love to be able to say hello to you. Glad to have you guys here. And we're going to talk a little bit more about what we have going on in our ecosystem. And then from there, we're going to talk about our main topic. And we're going to talk about financial documents. And sometimes that can be really scary for people when you're first starting to learn about real estate and how to evaluate deals. And so we're going to try and demystify that a little bit for you tonight. Ed has some good things prepared for you, and we're going to talk a little bit about what you need to ask your brokers for when you are trying to underwrite a deal and throw things into your napkin. And then it's going to be your turn, your time to shine. We want you to bring what deals you guys are working on. We want to see, we want to try and help you guys out and provide value for you and help you evaluate the amazing deal that you're working on right now. And if you don't have a deal, then Ed has some old deals that we can throw up here, and we can talk through that and kind of show you the process. And then after that, we would love to hear your questions and the answers that you
don't put all your money in the bank.
Don't put your money all in the bank. That's right. Put it into real estate. That's what we're here about tonight. So not sure who said that, but yeah, I'm with you. So and then we're going to do some Q&A at the end. So so we're looking forward to that. So just quickly, we're going to do a quick introduction of who we are. So Ed, feel free tell us a little bit about who you are, and then I'll introduce Aldo and myself.
What's up, everyone? So for those of you that are in here earlier or had heard me before, I'm based out of Los Angeles, California. I had a real estate background, licensed here in lovely California. Got tired of the day-to-day transactional real estate side of things, and jumped into investing, and found my way to multifamily, where my passion is. I love it. It's fun for me. Kind of obsessed with it, to be honest. This is what I do full time. I specialize on the underwriting side of things, hence why I'm on this call, but having the experience of being a broker or an agent as well. I also love jumping on with Mr. Peter on Mondays for our broker call, which we'll give you guys more info on the next few slides. But yeah, my name's Edward again. My phone number's here, Instagram. Call me anytime. I don't have a W-2. So I'm always available to help you guys out. Love to show you guys how to underwrite some more, or any questions, that we're here to be resourceful and be someone that you could come to anytime with a question. So please don't hesitate to reach out to me, and I'm looking forward to meeting each of you.
Awesome. Thanks, Ed. And this guy doesn't have a W-2, but he's about ready to have a $200,000 to $300,000 paycheck. So we're pretty excited for this guy. So we're speaking it into existence tonight. So we're pretty stoked for Ed, but good for you, brother. But hey, guys, my name is Will Otis, and I have my ride or die partner with me, Aldo and Chetta. We are with Stoic Holding Solutions. We're based out of Chattanooga, Tennessee, and we invest in the Knoxville, Chattanooga, and kind of Birmingham markets. And but we're just super excited to be here with you all to provide value. Aldo and I, we go back 15 years to college, and we actually have W-2 jobs. We work in the senior living industry. We've worked for several different property management companies in the senior living industry. I'm the vice president of operations currently, and Aldo's director of asset management. And so we have a lot of experience managing assets and evaluating them. And so anyway, we're just super excited to be here with you all this evening, learn about who you are and what you guys have going on. And, we're both Aldo and I, we have young families and our better halves. And, we work W-2s just like probably the majority of you all on here, except for Ed. But we are working towards that goal of having that financial freedom in multifamily real estate. So anyway, we're super excited to have you, and we would love to get to know a little bit more about you. And so who are you? And I know Travis, he jumped on here. He got his video on, so I'm gonna call him out. And this is his first time here on the Zoom. So Travis, tell us a little bit about who you are.
I'm a real estate broker in the Houston, Texas area. I've been in real estate most of my adult life, roughly about 30 years, and I done a little bit of everything from single family to some small apartments back in the day. But I'm looking to want to acquire my first large apartment complex, preferably 100 units or more. But I got several different softwares to evaluate properties, but let's just say it's too time consuming trying to go through all the software. And so lately I've been hearing about Napkin Underwriting, on different forums, and then I ran across yours. I ran across your Facebook group, so, let me check this out, because it just can help me to weed out a bunch of deals that may be some lemons. I could focus on the ones that actually got real potential.
I love it, man. Well, man, we're so glad to have you. Welcome from Texas. And I hope that you find some value tonight. We have a wonderful tool that you can use. And it looks like Ed's already thrown that here in the chat. So, or maybe not quite yet, but we will be. And so we'll be throwing that out there. But yeah, man, glad to have you. And who else would like to share who you are and where you're from?
So actually, real quick, Travis, if you don't mind, if you can do me a favor, and also the two links I posted are for anyone new or for anyone that doesn't or just wants to be more familiar with our community and who's in it. The two links I put, one of them is directly to a spreadsheet that everyone who fills out the form, their contact information, their buy box, their superpower, what they're good at, maybe even something like one of them should be a little hobby or something fun about the person, a fun fact. So we created this directory so that even though they're not on this call, these are all people in the community who have filled out this form, participated in our group, have a presence on the Facebook, and it allows us to just connect better. So Travis, check that out. Anyone new here who doesn't have those links or hasn't filled out the form, please do. It really helps with allowing us to connect better. If you need boots on the ground somewhere, that's the place to look. If you have a deal that's not your buy box or that you're not interested in because of location, it's the location of buyers are there. Judy, I posted two links. One is the form, one is the spreadsheet. The form is what you fill out. The spreadsheet is where it auto-populates all your information. So every time someone fills out the form, the spreadsheet updates. I can actually see you guys on the Google Sheet. People are in the sheet, so that means you guys are opening it. It is working. So that's just a good tool that we've come up with to allow people to connect and easily find other people in the community. Because maybe not everyone's on this call, maybe they're watching the replays. But at the end of the day, we want to be able to make it easy for you guys to connect.
Awesome, man. Thanks, Ed. Travis, man, we're glad to have you. Who else? We'll do one more. Raise your hand if you'd like to get known, and we'd love to know who you are. And if you don't raise your hand, then I'm going to start calling out names here pretty soon. All right. Well, just because I can see you on the screen, I'm going to call out Natasha. Tell us a little bit about who you are and where you're from.
Hey, Will. Hi, everyone. I'm in Arizona, and I just signed on as an LP for 30 doors. So I'm excited about just
Nice.
getting into
Good for you.
a first deal and figuring
Heck
out how
yeah.
that's going to look. Yeah, so I'm excited about that. But I've been talking to brokers, and oh my God, sometimes I feel like I know more than they do, just from what you guys have taught. Like, why is why do they not know if garages are being charged for? Oh my God, and just stuff like that. It's pretty exciting. So I'm just learning, and I'm actually getting my realtor's license here for Arizona, just to kind of have some credibility, because I'm completely in a different field right now. I'm a nurse practitioner, so I'm still in medicine and very part-time, working for the Department of Defense and doing some military work. So I have a lot of time, and if you guys need someone in Arizona, give me a call.
Guys,
Awesome.
show some love for Natasha in the
Thanks.
chat. That's amazing. Thank you so much.
Yeah, throw some fires in the chat for her.
That's
Glad to have you,
awesome.
Natasha.
Thank you.
And
You
and
guys
I-
got me going on that broker thing. I'm like, after one of your broker call deals, I'm like, I'm just gonna call. I'm just gonna start calling people.
And you know what's funny is once you get your license, people are gonna start calling you, and you realize, I wish I didn't do this.
Yeah. And I'm actually more interested in commercial real estate, but one of the
Awesome.
brokers I talked to, she says she kind of does both, just to stay busy and stuff like that. So thank you for.
If there's anything I can help with the agent life, or just like if you're looking to
Okay.
residential stuff and marketing and XYZ, please reach out. You guys know I'm here to help out in anything I can. Having been licensed for almost 5 years now, I think. So yeah, let me know how I can help you out. Thank you for sharing, and best of luck with everything. That's
Thank you.
really great.
Awesome. Well, so with that, now we're gonna, let's talk about our ecosystem. Aldo, tell us a little bit about who MFC is.
Yeah. Thank you. And thank you guys for participating. This is not only an opportunity for you to get educated, but it's also an opportunity for you to get known, to get proximity, and to network with each other, and to grow as professionals as you meet people. So with that said, this is only one small piece of a larger puzzle of a community, really an ecosystem of learning, of education, and of proximity to people that can help catapult you. So we begin the week off with our activation Zooms on Sunday nights at 8:30 p.m. Eastern time. In that, the MFC core group, consisting of Marcel, Travis, and Victor, they get together and they talk to celebrities, basically celebrity folks in the multifamily industry. And so that's to get you activated. That's to get you to see the vision of multifamily. And then on Mondays, the following day after getting activated, we have a broker talk, and that's with Peter and Ed. Actually, that's with Peter and Ed, and you guys are gonna get on there, and you guys are gonna call brokers, and you're just gonna get it done. You got to take action. It's all about taking imperfect action. So once you do that, that's the first step of trying to acquire a deal. You have to find a deal. After you find a deal, guess what? You bring it here. You bring it to this Zoom, and we put it in the Napkin Underwriting, and we try to see if it's we need to come up with a nice catchy phrase. Is it a deal, or is it a steal?
Is it clean or dirty?
Okay, come on, get out of here. Is it a stud or is it a dud? How about that? And so we'll walk you through that in the basics of underwriting. And then on Wednesdays, there's a couple of different Zooms that happen on a bi-weekly basis. In fact, tomorrow night we have Jerry Miles and the Miles family, Jerry and Sherry Miles, who are debt brokers in the commercial real estate space. And so once you find a deal and you underwriting, if it's gonna work, you got to find money to finance that, right? So Jerry and Shelly are going to be great resources for you to be able to see if that is the case. And you're going to get to know about the debt market and some of the intricacies and nuances that happen or that take place in that environment. And then every other Wednesday, we have advanced underwriting Zooms with Victor N to the G, the ninja himself, who has just poured into himself all kinds of education and learning, and is giving that all out into the community for free. And so this is just the initial part of underwriting. Once you know it's a good deal, then you have to learn and understand how to take it to an analyzer and get good results out of that, so that then you can go and sell it to your investors. So with that said, that is our ecosystem, and we're just so glad that you guys are a part of it. You guys are the reason why we're here and what give us all the energy that we need to keep going. So thanks for being here. This is our contact information. This is just for you to have, take a picture of this, download it, I don't know, memorize it. If you have any questions, or if you need to know anything about underwriting, whether it's napkin underwriting or even more advanced underwriting, we'd be happy to help you with that. Or any questions that you have along the way, we'd be happy to sit and chat with you guys. Okay. Edward, William, and Aldo. So with that said, we're going to go ahead and just get started in our topic tonight. How about that?
Awesome. So basically what the topic is and what we're looking to go over is what are these financial documents that you always hear thrown out there, whether it's brokers, other investors, anyone looking to underwrite. The two ones are the T-12 and the rent roll. So I just brought up, can everyone see my screen? I want to make sure that's good.
Looks like it's coming up.
It's working on it.
Okay, so it says it's loading. Hopefully my computer, okay, cool. So we just want to show you very simple what to look for, what it is, and also what these docs essentially do, what the benefit is. We're not going to dive too far deep into it because we could spend a full hour on each of these. Well, T-12, not so much the rent roll, but we could spend a full hour on that, trust me. So yeah, we're just going to go over what they are. Well, I was going to ask a question and realized the answer is right there. What does T-12 stand for? Trailing 12-month income expense really sums it up. I caught myself. I almost blundered there, but we caught ourselves. So trailing 12 months. Obviously, this isn't recent, as we mentioned earlier. This is just an example, but you want to make sure that it covers 12 months. Simply because the last 12 months will paint you the best picture of how this property is performing. Also, if you do, just for context, if it's a T9, T6, T3, it just means trailing of that many months. Why it's important to have a T12 and not something less is a T3 may not have their insurance, may not have their taxes all the time. If you're paying those twice a year or quarterly, you're gonna miss those important expenses that are gonna be a big component to any underwriting you do, whether it's napkin, whether it's advanced, or anything in between. So it's really important, I personally think, to have a T12, just so you can get the full picture of how the property you're looking to purchase has performed in the last year. It's a report card, essentially, with a lot of numbers that are relevant, okay? Like I said, it's very easy to dive into this and have a lot of different things to look at, but one thing you want to make sure that's always on the T12 is, of course, the rent. And why this is important and why we want to make sure that we have access to a T12 that matches the rent roll, and I'll show you guys the rent roll in a little bit, is you want to make sure the numbers match, because this number is being taken directly from the rent roll, okay? And I'll show you guys that once we get over there, but it's really easy on a T12 to just assume all the numbers are correct, or think, oh, okay, if it's this on, or this number on one, this number on the other, those are both fine. You just kind of go with what they have written. One thing you'll hear me say a lot on Mondays with Peter is, if you have access to these documents, just look through them and ask questions about stuff that you might be curious about, or that might seem a little off. And we'll have another Zoom where we dive really deep into these, or maybe Victor will have it on one of his calls, but I don't want to spend too much time going into each line. But the more practice and more familiar you get with a T12, the more you'll see how some of these numbers sometimes may be a little off. And it's a good way to ask the question to the broker and show you've done some homework. I think that's the most important thing. Brokers want to talk to people who have invested into actually doing some homework and knowing what they're talking about a property. And I was telling Will and Aldo today, this property I'm looking at here in LA, I know the details so well because how many times I've repeated it that I think if you woke me up in my sleep, I'd be able to tell it to you at this point. So that's just something that when I'm talking to brokers or other investors, it rolls off the tongue very quick, easy, and it sounds like I know everything about the property, where in reality, I probably don't. So you're gonna get generally what the income is. You're also gonna see what the expenses are, and this is a good T12 because it's very detailed. Don't get me wrong, you will find some that aren't. I'm sure Will and Aldo can attest to that, where sometimes you look at T12 and you're like, where's the rest of it? It's frustrating, but sometimes it's nice to have too much information than not enough, because then you can account for everything and weed out what you don't really need. And then you just have the expenses down here at the bottom of the total expenses right here. And then you get your net operating income. So anyone that hears NOI thrown out there, this is what it means. Net operating income. Essentially, it's your total expense and then total income. So total income minus total expense equals NOI. That's a very simplified version of it. Like I said, we could dive more into this, but we'll hop over into a rent roll just to show you guys what this looks like. And then one convenient thing about this rent roll is they have a floor plan summary, which not all of them do. But yeah, so this is just a rent roll. Will, Aldo, do you guys want to jump into this one, or should I continue?
No, one thing I'll just note is that every T12 and every rent roll looks different. So there are just some key components on these, and specifically in the rent roll, which is really what we're going to use mostly in our napkin underwriting. They're going to look different. So it's just going to have the name of the person, and it's going to have a rent. And there's going to have sometimes a column that says market, where the market rent is, and then where the actuals are. You want to look at the actuals. We want to know how it is actually performing right now. And you also want to notice whether there's a vacancy there or if there's a vacancy coming up in the next month or so, or even in that same month, because I mean, I would count it as not being there. Okay. And so those are just some of the important things that we take a look at on there.
Yeah, just a quick, just again, to take a step back to, as you are speaking with brokers. So yesterday, if you're on the call with Peter St. Martin, who's in the house tonight, Peter, we're glad to have you here, man. And of course, Ed is on that call as well. When you are reaching out to the broker and you're trying to evaluate a deal, these are the documents that you are going to want to ask for to really give a good picture of how the asset is performing financially. Okay, so the first one that we're talking about is our T12, which again, what does the T stand for? Throw it in the chat if you remember what the T stands for in T12. We'll see if anyone's listening, but that is your trailing, there you go, trailing 12 expenses. So that is your past 12 months of expenses. And again, that's just going to give you, I think the best thing that the T12 gives you, as Ed shared, is really gives you a good insight quickly on how your asset is performing. And the key components of your T12 are going to be your revenue, how much money you're generating, what are your expenses, how much money are you spending on the expenses, and then that provides you your net operating income, which is your revenue minus expenses. So again, just to kind of sum that up.
And last thing I want to add to that real quick, will give me a thought on this is you want to make sure when you're factoring and you're trying to get the different numbers averages, factor in the entire year. Because although yes, you do want to know how it's doing today, you want to have your recent rent roll that shows you how this month is. you want to look at the T12 and see what's the trend. Was it a lot higher a few months ago? Was it a lot lower a few months ago? Why? But these are all things like you don't want to buy someone else's problem. If anyone's heard anything in real estate, that's the perfect way to put it is if you don't know what happened a few months ago and there's a massive discrepancy here, you might be buying something and there's a problem there that you weren't aware of. And guys, I hate to say this, but it's the reality of it. If a seller's thinking about selling a property, to make their numbers look better, if they have a high vacancy, they'll just rent out property, their units for pennies on the dollar, or cover up problems they may have and have a tenant thrown in there. And now you are buying someone else's problem. And if the inspection doesn't catch that, that could be a really big bill. And I'm not talking from experience personally, but I've heard horror stories where the person didn't get into the unit. They open up the unit after and realize they gutted it. What are you going to do at that point? You've already closed. So it's just the T12 tells you a story, and be aware of the trends and why did, for example, this is a bad example, but if there was a massive discrepancy for a few months, ask why. It's a good question to ask the broker on those calls.
All right. Does anybody have any questions on that right now? We'll have a Q&A later on, but any specific questions around this small topic tonight? Great. All right. I think we're ready to get on. I think we had a few people that had some deals they wanted us to throw into the calculator. So I'm gonna go ahead and share my screen here.
Do we want to talk about rent roll really quick?
Oh, I thought we did. My bad.
Yeah, sorry, that was T12. So let's talk a little bit about rent rolls, just really briefly. So Ed, go for it, man.
Yeah. So one thing that's important on here, it's really important that you also on the rent roll know when the leases are expiring. What are the type of buildings most of us, and what are the most properties anyone looking to get into multifamily should be looking at? Obviously, not everyone, but most are going to be looking at value add. You can't rehab a unit unless the lease is done, at the minimum. In California, it's a lot more than that, but you get what I mean. If the lease is still active, for example, this one expires May 2023, right? You are not getting into that unit. Like that tenant is not leaving no matter what you say. Now, after the lease expiration, if they're month to month, for example, like this one is, then yeah, you can go in and improve the unit if you are ready to. So knowing when the leases end and kind of strategizing like, okay, if you have X leases that all end around the same time, okay, then I know I need X CapEx to put into the building, into those units. All right. At the end of the day, you are playing a little bit of like a strategic, what can I do? What can't I do? How quickly can I do it? Because just having a CapEx budget, but not knowing how you're going to allocate it can really be detrimental to the big picture when you are actually trying to get these units turned around up to the market, the high end of what you're trying to get it to maximize your rents, which is all the objective of every building you're looking to buy, is to maximize these rents. One thing you also want to be aware of is this column right here that says other income. You want to know what this other income is. That's first and foremost. And usually that is made clear on the T12. So allows you to see where the opportunities are and what they're capitalizing on. But also what this does is shows you, okay, what aren't they charging for that I possibly could? I think that's important too. Because again, it's all opportunity. You want to be aware of what opportunities available to add value. On one of the activation calls, I think it was Robert Martinez, where I'm not going to try to remember the numbers because I don't want to butcher it, but I think it was like every dollar equals X amount of value added on the property. And when you actually put in that perspective, it's kind of crazy how quickly you can add value and increase the property's value, bottom line, what it's worth, by just doing these small increases in rent, in other income, in lowering expenses. If you don't know what you're getting yourself into, you don't know how to improve it. And the rent roll and T12 tell that story. Sometimes you'll get notes like this, which is nice, renovated, not renovated. That does help. And then of course you'll see the vacant, occupied. And here's actually one more thing that I want to point out that I just noticed. When it says non-revenue, this, for example, is on a 202 unit building. One thing you want to keep in mind, a building of that size likely has a on-site management. Now, they either don't pay rent, and that's kind of part of their salary, or they pay market rent, whatever that is, but they get a discount based on their hours and how involved they are. So that's something to keep in mind. If someone tells you it's 202 units, you don't want to underwrite it because you're not technically getting rent for that last unit. That's something to keep in mind. It's a little trick that helps you get more finite underwriting and a little more accurate, because you don't want to factor in for a unit that obviously you can't capitalize on, or it might be a management office. That I've seen that happen as well. So just some things to keep in mind. But the rent roll is fairly straightforward, and like was mentioned earlier, they do all look different. This is on the more fancy end, I guess, a little more informative than you might usually see, but it does give you a good idea of what it looks like. This I think is very important as well, seeing what the unit mix is, and this is just a general nice thing to have. It doesn't usually have this, unfortunately. We would love for it to always have a unit mix, and the floor plan summary as well, renovated, unrenovated. So any questions on the rent roll? Is there anything that so you guys have a question on?
How many people have looked at either a rent roll or a T12? Throw a 1 in the chat. And I'm not talking about the one we have up on the screen, but how many of you have actually looked at a rent roll or a T12 on a deal? Go ahead and throw 1. Awesome. All right, there's a few of you. Good deal.
Sweet.
Awesome.
One
Well,
last
hopefully
point. Sorry, one last point I want to make, and I think this is very important when you are underwriting, whether it's at a napkin or advanced level. Obviously, like I mentioned, this is an older deal that I pulled up, but you want these to match. September 2022, September 2022. You want to make sure that the T12 is recent. If obviously this is 6 months ago, this is irrelevant to me. This has, like, I would never use a C12 if I'm underwriting today because it's just too old. Staying with the rent roll. So that's something to keep in mind. Like if it's a month or two off, I might be okay with it, hoping there wasn't too many changes. If I'm just doing the underwriting, obviously when you get into contract, that's a different story. You want updated numbers. But if you gave me something now from like January, I'm okay with that. You know, once the month turns and we hit April, that'll push into February, right? So that's something else I just want to mention, where just because you receive a T12 or receive a rent roll, make sure the time frame is there, because a lot could change in a few months, especially when you look here and all of a sudden you see a lot of the leases had expired in between that time, and the broker's just trying to hide it from you, or the seller's trying to hide it from you. Keep that in mind. It's a little trick that a broker might play, or a seller might think they're playing or getting away with, where you don't want to, you want to have the most up to date, but a month or two is okay.
good deal. Thank you, Ed. Appreciate that, man. Aldo, you want to take it away from here, man?
Absolutely. Let me go ahead and share my screen. All right. Who's got a deal for us to look at? Let's see. Here we go.
Chuck Russell does.
Chuck, hit me with it, man.
Aldo as well, if you can you share the link for that and put in the chat, so if anyone doesn't have it, like the people who came for the first time, we can make sure they get that too.
Are you guys able to see my screen?
Yeah, we can see it.
Okay.
Actually, I have it here too. I can share it probably. Cool, I got it. I'll share the link. You're good.
Good deal. Good deal. Somebody had posted one in the chat here. Let's see. Oh, God, no. Here we go.
All right. So
a
while
from
Aldo's
Florida.
putting that, pulling that up, I did post the link to the underwriting tool in the chat. It's only a viewer access, so all you'll do is go to file and make a copy. One thing I recommend anyone using this tool, anytime you underwrite a property, whether it's using this tool or any, I highly recommend always make a copy and have the title of the new copy you make be the property address or whatever the subject line is, you got it in the email, and then don't delete it. Like save them, because you never know, one, if that deal comes back, maybe seller, something happens a few months, they didn't get the interest they hoped, or maybe they opened escrow and closed, or fell out of escrow, and you're like, oh, I remember this deal, or I don't know if I saw this before, it looks familiar. If you have all of this saved, you don't have to reanalyze your deal. I think that's the most frustrating thing you can do, is have to run a deal multiple times because you forgot to save it, or you overwrote the numbers. So I save every deal I've ever underwritten. So yes, my Google Drive hates me, as you can imagine. But anytime someone sends me a deal now, I just plug in the address and I know if I've seen it before, which saves everyone a lot of time and headache. Also, if a deal resurfaces, like happened this weekend, I can jump in real quick and I have the numbers and I just update what may have changed. So I think that helps with organization. Also helps when you're just trying to get some feedback. You know what deal you're talking about, and you're not going to lose your data. So that's just I'm going to remind you guys often about that because I've made that mistake. It's not fun. So just a little tip for the calculator.
There
That's a
you
pro
go.
tip right there.
That's right. Hey, so I did get one. I think it was Matt Clark. Yeah, you've got a deal going here in Florida. What I don't have is average rents. So I don't know that we'll be able to plug it in there unless you're able to just type it in there really quickly. Yes, Jennifer, this is a new version. I added current in-place rate, basically matrix, so that we can be able to calculate the total average rents if you have multiple unit types. If you have 1-1s, 2-1s, 3-1s, or anything like any kind of unit mix. Yeah, we thought so.
And
So-
Jennifer, yeah, and you might have been using the old Napkin version that Ed and Eddie Charger were using. So this is a different version. So feel free to download it. It's probably a little bit more simplistic and hopefully a little bit easier for you all to use. So yeah, we'd love for you all to download it. And props to Aldo and Ed for really pulling that all together for us. So.
Renee, we went ahead and put it in the chat. So if you don't find it, we can post it. Once
I
again.
put it up there again.
There it is. Okay. Hey, Ed, why don't you pull up a deal, man, for us? Maybe a ghost deal.
Well, even though it's older, we can still use the numbers from the one that we just had up.
Yeah,
Yeah,
man. Shoot them in here, bro. How many units is this deal?
202.
202.
Renee, it looks like Renee has a question. Renee, feel free to unmute yourself, brother.
So I do have a deal. It's 24 units.
Go for it, man.
So what do you need?
I need, unit count, average. If you have the number of average rents, we can put it in here, or we can figure it out by putting it.
I do. I was actually doing the underwriting on this yesterday.
Okay.
So average rent is 1820.
That's pretty good. Where is this?
It's in Phoenix.
Oh, in Phoenix. What's the occupancy on there?
It is 87.5.
87.5. Do you know what the asset class is on this one?
It's an A.
It's an A class. Okay. Do you think it's going to need any rehab?
It's a new construction, 2022, I believe.
So none really.
So one thing I want to jump in real quick, we have the rehab level, even when it is a new construction 2022. For example, I would personally put in light for the simple fact that it's better to have that money available because you never want to go back to an investor and say, hey, at the end of the day, you're dealing with AC, you're dealing with the roof, you're dealing with people living on site, you have parking lots. If something happens and you're not prepared for it, and it happens even the first year you acquire the property, it doesn't hurt having those reserves, even if you're accounting for it, because you'd rather be safe than sorry. The
Right.
last thing that an investor wants to hear is, hey, the unit flooded, we don't have money to rehab it. It's like, dude, didn't you guys prepare for this? It just looks bad. So even if it is a brand new construction, trust me, you can move into a flip or a brand new construction. Once people start living there, you realize not everything's working 100%. At the end of the day, real estate is real estate. Stuff happens. Don't let it be something that's unexpected that you aren't prepared for or financially ready for, because that can take you out the game and you haven't even owned it for 6 months. So I would put it in there regardless, just my 2 cents.
Right. And so as to your question, how much weight does it have in this calculator? It doesn't have any actual weight into what we're looking to do with this calculator specifically. It just gives you a number so you can have like a ballpark. Okay, so we've got 24 units at 8,000 a unit, from a ballpark standpoint. We're looking at $190,000 in potential rehab. Now that could be a lot less than that, depending on your comfort level, the risk, and your comfort level with the asset itself. But you just have it there just in case. You can slash it in half if you want, depending on what your plan is and your business plan for that particular asset. All right. So we've got basically all the inputs. What is the guidance price on this, man?
7.6 million.
One more thing, CapEx isn't always repairs. You might want to add a dog park. You might want to add a playground. You might want to add covered parking. You might want to add XYZ, a gate, whatever it is. That's all CapEx budget, right? So it's not only rehab in terms of something's not working or something needs updating. It's, hey, I'm adding XYZ. Something to keep in mind as well.
Yeah, Natasha. So it depends. It really depends on what your business plan is, and what you're going to use that money for. It could be a year, it could be 6 months, it could be 18 to 24 months. It depends on how you're going to execute your business plan. And if it's for flips for each apartment, it might take you 18 months, 24 months, because people need to vacate that. You can move people around. This might take you a while. So it just really depends on what your plan is.
And of course, it also depends how many units you need to do, because there's only so many units you can do at one time. There's only so many units that you're going to have the resources to do at one time. And to the point of the rent roll, like I was mentioning earlier, if all of the leases come up in a certain time frame and you have the ability to sit on those or eat the cost of lack of rent while you are rehabbing, then obviously doing more is better. But if that's not the case, or it doesn't work out that way, the unit count is a big component of that. So I would never, ideally you want to do it in a year. I wouldn't guarantee it. I think you want to push it out at least a little past a year. And how extensive it is obviously a factor as well.
Right. So, Renee, do you know what you could potentially drive the rents up here to?
You know what? No, I don't.
Okay, that's fine. And this side of it is more for, what we're looking at on an exit standpoint, which is good to know. It is good to know what your, CapEx looks, or not your cap rate looks at exit. So right now, what this what's that?
I haven't spoken with the broker, but it is in a very desirable location, very close to downtown. A lot of jobs there. So not sure.
Okay. Would you happen to know? So we're using just a rule of thumb, 45% expense ratio. Would you happen to know or have the information around that from the T12?
Yeah, the expense ratio is 30, according, from the T12 is 33%.
Okay. So we can look at both of those, right? Where it is actually right now. And then of course, we know that oftentimes at least two things are gonna potentially change. Your taxes potentially change because and it's been my experience every time I talk to brokers and owners, et cetera, people that just purchased, your taxes likely increase that first year because it reassesses and then they go ahead and charge you the tax bill. So there might be a reassessment the year of purchase and you're going to have to pay a higher tax bill. And then your insurance rates might go up. Right, so your taxes and your insurance rates are, typically going to go up that first year, and just those two things are going to increase your expense ratios, which is why we use a 45% ratio just to be conservative. Again, that's being conservative. So if we plug in, by the way, I'm going to hard code this. I'm going to plug in a number here, but just make sure that you make a copy of it so that you don't lose the formula here, because there is a formula here. So if you do it 33%, it changes the going in cap rate. I don't know if you noticed that. So we're going to stick with 45% and then we'll switch back to 33%. And so what this calculator is telling us, really the purpose of this is to tell us, what is my going in cap rate? What is the total return from an NOI standpoint for this particular asset if I were to go in unleveraged? If it was all cash, what are my returns going to be on an annual basis? Right now, it's telling me it's going to be a 3.3% cap rate, going in cap rate. And this matters a lot more than your market cap rate, in my opinion, because this is going to help you compare to your debt quote. So when you're on there tomorrow and Jerry tells you, hey, the 10-year treasury, actually the numbers came out today. I'm not sure if they've, well, they're meeting today. I'm not sure if the numbers have come out, but the 10-year treasury plus, from 1.5 to 2.25 points is going to be your agency rates, somewhere along that line. So we know that right now you're going to be on a negative, I forget what the term that they call this, but it's, you're basically negatively leveraged to where your cap rate is lower than your debt. And that's not good. Right. So,
sorry, real quick, jump in. The only way to offset that, and the only way and how this is where it's important to understand how the brokers are underwriting it when they present an OM, is the way to offset that is by just putting more money down. That's not necessarily the solution you want, because that affects your cash on cash. And at the end of the day, I can make any deal if I just the amount of down payment I put, because that just means my debt is lower, so the percentage impacts me less. And I don't want to get too much into it now, but this is where the creativity of the deal will allow for you to enter at a cap rate that may not be as enticing to everyone. If your debt is at a great price, you're able to be creative, you can create a good deal out of a not so great cap rate.
Right. Yeah. I mean, just to kind of speak into that a little bit, if you're able to get somebody to give you, say, a 0% down payment, 0% interest, seller finance deal, this is a no-brainer. And if they gave that to you for, 5 to 10 years, this is great. Now, of course, what you have to keep in mind is that on exit, when you sell this, your exit cap rate might be closer to like a 6.5, 6. If it's an A class in a good market, maybe a little bit below 6, because they're pushing up into that. So, you're actually going to be at a loss. If your NOI doesn't change, you'll lose money. Now, of course, you're going to work to, bring this up. So it's just you're going to exit slightly above where you came in, depending on the numbers. So,
and I just want to applaud Aldo, because that was a phenomenal explanation for the past few minutes. So guys, show some love in the chat, because I was sitting here, I'm just like, I'm happy I don't need to jump in. Like, this is amazing. So great explanation, Aldo.
So,
no, of course, man.
So my question is, You know, the T12s, when I read the T12s and then I underwrite my deal, you know, like the Napkin Underwriting, their NOI there that it shows, it's actually 224.
Okay.
So it's even lower than this. That means that, just let me double check what it is, but I'm pretty sure it was.
So I'm curious as to why, because also we have a higher expense ratio than you said that was on there. Is it because of their occupancy or is it because of the rent?
Not sure what it is, but I did take the average from the rent roll and then just divided it by the occupant units, and that's where I got the average.
So sometimes the rent rolls in your T12s are going to be at odds with each other. Just because sometimes brokers get you a more recent rent roll and it's more easily available to give you a rent roll than it is to give you a T12. And so I don't know when, if the dates match, if they don't match, that's what could potentially be going on with this.
Okay.
If not, because you know what I'm thinking about is if you have a recent rent roll and your occupancy has increased, then it's going to show a higher potential NOI than a T12 that is older with a lower occupancy.
Also, one more thing I want to point out, it's important on a T12 when you're looking that you don't divide it by the gross potential rent, because what the first line usually is the gross potential rent, and then you'll see lines under it that'll say like vacancy loss or loss to lease, which means they'll offset essentially what they think you could get once, like if you're running at 100%, which no one ever is, no building ever is. So they'll take you like, hey, this is at 100%, and then they'll have two lines deducting occupancy and loss to lease. So then you'll get your actual rent number a few lines down on the T12. So I don't know if that was the reason, but that's something just for general knowledge everyone to look out for. Don't always use the gross potential rent as the rental income because they haven't factored in loss to lease or occupancy yet.
Right.
Yeah, and the rent roll is from February and the T12 is March.
That could be a factor too.
That could be.
Yeah.
Could be.
But here's the thing, you said, what was the NOI? You said it was lower than the amount we have now?
224.
Yes, it's 224.
Okay.
Right.
Is that for that's on the annual for the T12?
It is.
Okay.
Yeah, I mean, I'm just reading what, you know, it's there. So, you know, the rent, other income, and then, you know, expenses, and that's where the number, you know, comes from.
So that could also be because, you know, I don't know what occupancy was like earlier, you know, say a year ago. And so that can also impact what the NOI looks like because occupancy has been leasing up over the past year. And so that could be potentially why your T12 NOI looks a little bit lower than what we're showing right now.
And that probably could be it, but it's actually, you know, 2022 construction.
Okay.
So I think it's the newer rents.
That's
Got
what
it.
it is. It's
Yeah.
a 22 construction. So, I mean, you start at zero basically.
Yeah.
Right.
And so that makes sense. That's pretty strong. That's pretty strong for a 1 year new construction. I mean, they've leased up essentially all the way up.
Yeah, and that's something that I gotta, you know, that where I'm struggling, you know, how to read the documents, and it could be overwhelming and, you know,
Yeah,
stressful.
Renee, I mean, we'd be happy to jump online, you know, after, you know, at some other point as well, and to kind of go over the numbers with you, man, and see what we can make sense of it, and maybe go through some of the, you know, some of the histories on that.
So
Yeah.
here's a quick question as we're getting close on time. Is the average rent what the 1820 they're getting now across the board, is that close to market rents, or do you think there's room to improve those numbers?
I think the market rents are higher,
Okay.
so there is room for improvement. Yeah,
Got it.
we can double check on that, but I think that they are.
Okay.
So just really quick to finish this off, the other side of this part of the napkin, you put in what you think you can get to, you know, in the next 3 to 5 years, or what you can push rents to, what you think your occupancy is going to be after managing it well, and then what it's going to spit out is your cap rate at exit, right? So it's just going to compare it to the purchase price that you bought it at. And you can see that there was, that your cap rate increased. Now, right now, the upside is essentially negative because of, we're going in at a really low cap rate. And so we're not really getting the money out of it. So you're gonna really have to get into the number, see where you can take it to, see what you can do with the expenses, etc. But this is just one way to kind of do that. Now this is this exit cap rate is basically like, the market cap rate around the A classes. So let's just say that you can sell this at a 5 cap rate. I'm just throwing out there, an old A class cap rate number. Be able to sell this for under what you purchased it, because as you can see, you went into this at a 3.3 cap rate,
Right.
and you're exiting at it. So you're gonna have to really put in work into the average rents to get them there. So
Yeah, and my napkin NOI came out to 3.2, so very close to what you have.
And one more thing I want to add as well. One thing you have to factor in when you have a new build, and this is more on the higher class end, is if they haven't implemented the appropriate, if you haven't implemented the appropriate additional income from your initial tenants that you read. Because think about it, all the tenants that are living there now are the first people to live in the building. So if they don't have that additional income in place, such as like a RUBS program or pet fee or parking, charge for parking, then that's a big component in how you can add value. And the napkin doesn't show that, but the point is that you then do some homework and like use your best judgment. Like, okay, is there room for this upside? If you can't do, then okay, let's take it to the next step and dive a little deeper.
So just really quick, we're coming up on time here, and we are here on time. Victor's asked a really good question, and Travis has a question. What we'll do, we'll just cap it right here. We'll try to answer them as quickly as we can so we can let you guys go. But Victor's asking, for a 22 build, why do you need 8,000 a unit rehab? That's a great question. And we were talking about that, and you really don't. It's just to kind of give you an idea. It's a rule of thumb that is on here based on the A class and the rehab level. You probably don't, but it's good to kind of take a look at and see. This could go into more of a, what would you say, working capital, or like a reserve in case anything were to happen, but you don't need the 8,000, and it does not weigh into the calculator at all. It doesn't affect any valuation or any kind of going cap rate. Travis, what is your question, sir?
Yes, sir. Commercial rates are going around 7-8% on average right now, if I'm not mistaken. Correct me if I'm wrong. With that being said, why would you want your going cap rate at 3% and your exit at 5% if the interest rates are around 7-8% right now at the moment?
So this is what the calculator is for, is to help you to see what your going in cap rate is. And yeah, I mean, it's pushing close to that for sure. It's in the 60s. The last quote we got was pushing in the 6.25. That was a couple months ago. But it's definitely pushing to that. And Jerry we'll talk more about that tomorrow evening. So make sure you go in there and look at go to that Zoom.
Well, because my logic is that I would think that you would want to have your cap rates higher than what the interest rates are.
Correct.
That's exactly right. That's what's
sorry,
that?
The going in cap rate, I want to make sure we're on the same page. That going in cap rate isn't what we want to go in at, is what based on their asking price and the NOI they provided us, what they're asking us to go into. Do you see that difference?
So you're saying that that's just what the software had spit it out, but you prefer to be at above what the interest rates are at. Is that correct?
That's correct. And that's what this tool helps you to either say,
Identify.
this is not good, this is not a good deal, or this is a good deal, I'm gonna explore it.
Oh,
If you're
okay.
close, if you're coming in at a 6.5 or 6 3/4, then there you go. Yep, it changes every day into 5s today. Nice. So, but still, like if you're coming in at a 4.9, then you're like, okay, we're close. Maybe we can tackle this deal, maybe ask for a discount here or there and try to make it work. So that's an
And to-
excellent question.
And to tie the two questions together based on what Victor was saying, your better class area, your higher class buildings, the closer you are to A and the less rehab that's required, the more likely you're gonna get in at a lower cap rate because you have less capital that you have to spend after purchase to bring it up to standard. And that's a big component as well.
So one other question. So let's say this was a good deal and the cap rates were better going in. What would be a good exit cap rate for this property? Would it be in a Class A property? I mean, because it's brand new, so but the same token, you still mainly because because the market is very volatile right now. These banks going under, and there's a lot of talk about a recession is on its way supposedly.
Sure.
So I would think that you want to have a higher cap rate, to have a comfort, have a safety cushion, should I say?
Absolutely. That's a great question. So the exit cap rate is going to be determined by the market. We don't set that. So you can talk to your brokers, you can talk to property managers, analysts, etc. They will give you the exit cap rate in that area. Even your debt brokers, they'll underwrite for an exit cap rate 5 to 7 years from now or whenever, and you can get those from there. The market sets that, we don't. And so that's why you have to be careful with these in order to be able to come out on top. That makes sense. So guys, I hate to do this, but we got to wrap it out here. So Jerry says no one knows, it's anyone's guess. That's right. It really is a guess. It really is a guess. Marcel says there are ways to add value outside of just rehab, such as adding. Yeah, exactly. If anyone has the answers, they'll be a billionaire. That's right. That's exactly right. Well, guys, hey, listen, this has been an incredible Zoom. You guys have brought the fire. Renee, thank you so much for bringing this deal. It was super valuable. I got value out of this. I hope you guys did as well. And with that, we're going to go ahead and send you guys out, and make sure you come tomorrow to Jerry and Shelly's Zoom to learn more about the debt market.